Good morning and welcome to the Blue Business Basics, our monthly virtual Bigger and Better Business seminar series with various topics such as entrepreneurship, investments, or personal finance. This month's event is sponsored by the Lambda Sigma, Nu Psi Sigma, and Phi Beta Sigma Sigma chapters of Phi Beta Sigma Fraternity Incorporated. Special shout out to my brothers Ado and Elize, Dale Burgess, and Leonard Knight, my partners in Bigger and Better Business, who are always a pleasure to collaborate with. Today is our 2022 Self-Employed Retirement Symposium. As a small business owner, this topic holds extra significance for me because that's a topic you hardly hear about when it comes to having your own business. You always hear about the glamorous part, like being your own boss and having lots of alleged free time and making lots of alleged money and being able to do whatever you want to. But the flip side of being your own boss is being responsible for everything, including sourcing and paying for your own benefits. Those include retirement benefits. And it's a lot different from having an employer with a pension plan or a 401k plan with a percentage match. If it sounds like a lot, that's because it is. But fortunately, today's presenter can assist with getting that process started. Here to give you the Blue Business Basics on self-employment retirement planning is Nakia Sanford with PFS Investments. Ms. Sanford, I'm going to turn the floor over to you because I can't wait to hear what I need to be doing to overhaul my small business retirement plan.
Thank you, Brother Riley. I really appreciate it. Thank you, everyone who's tuning in. I'm so excited to be bringing some information on this very important topic. Welcome to what I call minding your business, right? When you have a business, you got to mind that business and make sure that it's running efficiently. We're going to be talking about some retirement resources for business owners. And before we get into that, let me get into a little bit of housekeeping. It's important to me that during this part, I am giving you everything in my brain that I can think of. I'm going to give you stuff that people pay money for, right? But this is a complimentary seminar for my brothers over at Phi Beta Sigma Fraternity Incorporated, and also a resource for you to make sure that you're running your business smoothly. So that's my give. And I have two asks as we go through this process. As you're hearing this information and think about this information, don't just listen, actually implement some of these things. And the second is, my business runs on seminars. This is all I do for the most part. So if you have a group or of people who you think would benefit from this information, please consider connecting me so that I can continue to share this information. Moving into the agenda, what are we going to talk about today? Well, I'm going to give you guys a brief introduction to who I am and why you might want to listen to what I got to say. And then we'll talk about some wealth building basics, because regardless of whether you have your own business or you're working somewhere, you need to have some good foundational information on what wealth building looks like. And then we're going to talk a little bit about mindset, because we can talk about money all day. We can talk about having a business all day. Part of that is having the right mindset when you're going into your business as well. We're going to tap into managing the money that you're making. What are some tools? We're not going to deep dive into this because everybody's business is different, but we're going to talk about managing that money that you make. I'm going to touch briefly on a couple of investment and wealth building myths, just to make sure you know what to look for as you're going out and hearing a lot of different ideas on what that looks like. And then we're going to get into the small business retirement options and break down what each one of these things are and what's available to you. There's a bunch of them out there, but we're going to cover about 4 or 5 of them just to give you some information. The goal is to have you start thinking about these things, and then you can take it further and do some research, or definitely reach out to me on the back end if you want some more details. And then I'll talk about some next steps and some ideas that might help you along your journey as you get started. So as it was said before, I run Impact Financial, which is powered by the amazing PFS Investments. I have been in business for 8 years. I actually coined the phrase, understanding money is not magic, it's just math. Because oftentimes we get confused by all the stuff that's out there, and it's really not a whole lot. It's just math. You got to be able to do the math. let's get into the who and the what, right? Who I am and what I do. So I'm an educator. I love, love, love teaching. This is one of my favorite things to do. But behind that love of education is some licensing. I have a Series 6, 65, 26, and also a 65, which is basically means if it has something to do with money, I can have a conversation about it and give you some information. I'm also a fiduciary. And what that means is whatever I suggest, it has to be the right thing. Often I'll say that and people will say, well, Kia, if people have licenses, shouldn't they have to do the right thing? Crazy enough, that's not necessarily true. They could suggest some things that are suitable, but not necessarily the best. I have to give my best advice at all times for my clients, and that's important. I manage serious money for people who are serious about retirement. I tell everybody, listen, I'm not here for the stuff in between. I'm here for your bookends. And those are the things that I'm going to be talking about today within your business, your bookends. I want to make sure that you're bulletproof if it's a slow business month or something like COVID happens. Are you prepared to make sure that you can stay in business or at least ride that wave? And then we are not put here to pay bills, work, pay bills, and then die. There's supposed to be some retirement time there at the back end of that. So we want to make sure both of those things are covered. Our what ifs and our wins. And that's what I'm here for. And this isn't a job for me. It is truly a calling. I tell people all the time, I can't believe that I get to do this every day because I spent 14 years of my life as a professional athlete. I played 11 years in the WNBA. I played 14 years total with my international career, and I was looking for me. I was a female athlete. I'm from Decatur, Georgia, where I grew up upper, lower class. I don't know what it is to not have food and shelter and love, but I didn't know nothing about money. So I'm looking and I'm finding people that have the licenses that I have today that wouldn't talk to me unless I had over $1 million. And for some people, the minimums were 250,000. So now I get to manage millions of dollars for people, but I also get to help people that are on their way to millions. So it's truly a calling, and my steps were ordered into this business, and it's very exciting. So let's get started. Now that y'all know who I am, let's talk about some of the challenges that are out there today. 30% of people that are working say that they have less than $25,000 in their savings and investments for retirement. Now, this is a study that was done last year, and almost half of Americans say they're run out of money in retirement. So people are working and they're not saving, or they're saving, but things come up. And one of the questions that is asked is, why does that happen? How is that possible in America? How is it possible that people can work for 30, 40 years on a job and not be able to retire? The first is people end up borrowing from their 401ks. As my mama say, your feet to the fire, and you look around and you see that money sitting over there, you tend to take from it. But when you're doing that, you're borrowing from your future self, which depletes your 401k as well. A lot of people leave their job and they go, oh, I have some money, I'm going to liquidate that. And so that money doesn't get reinvested, and they end up using it for something that's not wealth building. Some people leave jobs and leave their old funds there, and that money is not managed anymore. And some people say, I want all my money. I don't want to take no money on my check and put it in my 401k. Do you see how little this check is? Why would I take money out? And this isn't the seminar to talk about why you want to do that, but that is one of the things that afflicts a lot of people who even have access to that. And then I've actually met people like this. Why do I need to save for retirement? Even business owners, like, I'm gonna be rich one day. I got the next Facebook. I got the next app. I got the next whatever it is. Or, I don't need to worry about retirement because I'm gonna have this, and this. Well, you don't have it yet. So you need to prepare. And I have those conversations a lot as well. And it happens across the board. And then some people don't have a coach. I think that's important in business. I've had a coach all along the way. And without that, you don't have someone to bounce ideas off of. And so those are some of the whys that I found, especially working with small business owners, about why they're not preparing for retirement. So let's get into some wealth building basics. I'm going to hit a couple of topics very quickly, just to give you some things to research and look up for yourself. I tell everybody, Google what I say. It's all out there on the internet. This might be the part where you want to take notes. In between, I'm going to take some pauses to take questions so that we don't go from topic to topic. So hold your questions to the end, and then end of the sections, and I'll make sure that I make some time and space. So what I talk to people about in conversations out and about, or when I'm sitting down with clients or doing seminars like this, is to start thinking about being an owner and not a loaner. Because what we've been taught in America is to be consumers. We make other people's families rich every single day, every day. More importantly, we make the banks rich. I know my mother, my father, my great-grandmother, my grandmother were all hardworking people, and they only had access to what the bank would give them access to. But the bank takes your money, my money, his money, her money, and they loan it back to us, charge us interest, and they get rich. You walk in the bank, they got mahogany desks and marble countertops, and then we go home in middle America and we got Formica and pressed wood, because they're siphoning off our wealth. So I talk to people, and this is what we're talking about today, whether you're an entrepreneur or an employee, you need to learn how to put your money into the global economy. People like myself are in a position to give people access to that, because the bank typically will not. Be about team you. Be about your family. The labels on the back of our clothing, those people don't care about us. So we have to be thinking about team us, right? And making our families wealthy, because savings accounts, cash value, life insurance, all of that stuff has low rates of return. And we need to be accessing things that give us more money the same way other people do. The other thing that we want to think about when we're contemplating retirement is, what phase are we in? This is something that was not introduced to me until I got into the business. I was playing basketball. I was making the most money anybody in my family had ever made. And I'm sitting here like, I don't know how to make this turn into something else when I'm 60. But I was in that accumulation phase. And they say accumulation is from 18 to 55, because that's typically when we're working the most. But we're working longer now. So I beg to say 18 to about 60. And that's where you're making money. You're working the hardest you're going to work. If you have a small business, you're not going to be able to do what you're doing now at the age of 65 and 70. I mean, you might be, but you probably don't want to, right? So while you're working, wherever you are age-wise, you want to be thinking about accumulating and making sure that you're putting money in the right place for later. When you get a little older, 55, 65, I think it's 60 to 70 in that age range, because again, people working and living longer, that's the time to start protecting the hard work that you've done over the past 20, 30, 40 years. We got to go in protection mode. And then this is the most important, and this is where I see people drop the ball, is the distribution, the time where you start taking income from what you did before. Social Security is not going to save us. If you're under 40, you can forget it. I barely made the cut I just turned 46. I think it might be there for me. But right now we're getting about 70% of what we were supposed to get. And then the people behind us will get about 25 to 30% of that. And that little bitty check ain't gonna get it. You getting $400 or $500 a month when rent is $1,800 for a one bedroom. We're not going to be able to live off of those things. So we have to think about that and think about having a program in place for a comfortable retirement. And that's what we're here to talk about today. Now, this is one of my favorite things. If it doesn't matter if you understand investing or not, like I said, understanding money is not magic. It's just math. Here's some math for you. When I saw this after 14 years of playing professional ball, 2 financial advisors and an insurance agent, and I realized that not one of them took the time to teach me this, I was angry. There's another word I want to put in there that I won't, because my mama might see this, but I was angry. Albert Einstein, crazy on hair, he might have been our cousin because he had the afro. You know, he created something called compound interest. And I'm sure at some point in calculus or somewhere in school, I heard compound interest and my eyes probably glazed over because it was math and I wasn't a math person, I'm a numbers person. But this concept can be taught to 6-year-olds, right? This concept can be taught to a 70-year-old, right? This is just about where your money is and how it grows. So where you have your money determines how fast it doubles. The rule of 72 says you take the interest rate of anything your money is in and you divide it into the number 72. It tells you how many years you got for your money to double. So if you're getting 3%, you have $10,000 and you put it in an investment vehicle that averages 3%. Well, guess what? The bank ain't giving you that. The bank is giving you about 0.001%, right? So we won't even do the math on that. Well, let's just say you found a vehicle that gave you 3% and you put $10,000 into that vehicle. Well, 3 divided into 72 is 24. It would take 24 years for your 10,000 to go to 20 and another 24 for your 20,000 to go to 40. That is not exciting. I see most of the people that I can see their faces on this call, you are at least my age and you know how fast 40,000 would not last, right? But let's say you had a vehicle that was giving you 6%. 72 divided by 6 is 12. So that same amount of money, same amount of time is now doubling every 12 years. It's a little bit more exciting. But let's say you had something that averaged 12%. 12%, 12 divided into 72 is 6. So that same amount of money, same amount of time is now doubling every 6 years. That is a $40,000 to a $2.5 million difference. So the reason why I got angry about this is because I was putting my money in the bank. It's because no one would invest my money for me because I didn't have $500,000 to start an investment with. And so that not knowing this, stole almost $400,000 out of my retirement because I didn't have access to me so that I could be systematically putting money away. And that's what we're going to talk about. Another way to look at this when you're going about your business is paying yourself first. Okay, Nakia, I don't have $10,000 or $20,000. Heck, I don't even have, 40 years to sit and wait for my money to grow. Well, the older you get, the more money you got to save, but that doesn't mean it's not possible for you, right? We just have to decide what is a priority. But let's say at age 25, you would have started putting away $200, and we're not even talking 12%, we're talking 9%. And let me back up just a second, because the next question is typically, well, Kia, where do you get those kind of returns? The market has averaged double-digit returns in any 10-year segment since the daggone market started, since 1869 or whenever that started. That is how long we've been making money. It's over 100 years. If you take any 10-year segment, it's going to double-digit. We're in a recession, like not a recession, but a correction right now. So the market's down, the sky is falling, everybody's freaking out, but it's the average. It's like basketball. If I, score 40 one game and 20 the next, and then the next game I might have 10, and then I shoot up and get 35. It's what is my average? So that's what we're talking about. We're talking about actually investing your dollars and making sure that you're owning companies, not loaning money to companies or giving your money away. So as I was saying, $200 a month at 9% for 40 years. At the age of 25, you will have almost $1 million. And I tell people all the time, don't tell me you don't have money to put away because your phone bill $200. Like T-Mobile don't care. You can't call T-Mobile when you're 65 and go, hey, I've been paying you about $200 a month. I was just wondering if I can get some of that back for my retirement. They're going to laugh at you and call security or hang up the phone. So it's about priorities and where we prioritize. Waiting 1 year keeps $2,400 in your pocket, but takes $83,000 away from that long-term investment at 65. Waiting 5 years, you kept $12,000. Remember, we're talking about $200 a month, but it cost you over $350,000. And then waiting until your 40s costs you over $700,000. It's not timing the market, it's time in the market. So we have to start having investment conversations with our entrepreneurs, with our employees, everyone who's working. We have to have these kind of conversations because we need to be investing. That is what wealthy people do. They invest, they buy companies, and that's important. So people are hurting when they wait. So the last part of this is your financial independence number. This is something that I never, ever, ever thought about. And remember, I had 2 financial advisors. None of them said, hey, Kia, here's how much money you're going to need when you get ready to retire to maintain your lifestyle. Because right now, people are retiring and then rehiring. They're working for the school system for 22, 25 years, and then rehiring in another system. They're working for the police department for 22 years, and then rehiring in another system because they can't live off of what they saved over that 20 plus years. But if you want to retire in 30 years with $30,000 a year, you not only have to think about that income, you got to think about inflation. And if you've been paying attention to the numbers, we used to say 3% for inflation. It's tracking at almost 7 right now. Y'all see the price of gas. You see the price of milk. Heck, I stopped eating eggs for like a month because I refused to pay $5 for a carton of eggs. I just couldn't do it. I went and found somebody who sold eggs so that I can get it straight out the chicken, and I'd rather give them $5 than to give it to the market. That's how crazy these prices are right now. But if you don't think about inflation, remember we talked about that distribution period, you're going to run out of money because 30 years from now, looking at 3%, just 3% inflation, that $30,000 is going to spend more like $73,000. So you have to know what the number is factored in with inflation, because if not, you're going to run out of money. So if you wanted that kind of income, you need over $1 million, right? Well, how do you get there? Over a 30-year period, that's $585 a month. It's just math. Understanding money is not magic. It's just math. And ain't no feelings in math. It just is what it is, right? And so how important is that for you to know your financial independence number? Well, it's super important because if you don't know it, you're just throwing at a target with a blindfold on, and that's important. So I want to take a pause there. I know we went through a couple of items to see if there's any questions before we go into the mindset part of what I have to say.
Well, Nakia, that was some great information. Like I said, it's about the numbers and knowing your numbers. And you really can't get where you're going if you really don't know your numbers. And I think one thing that I can say for myself is that before I was just afraid to look at those numbers, but you can't move forward until you see your picture, you know? You really can't. So the bigger problem is not knowing what it is, because sometimes it's probably more attainable than you think it is. You just don't have a roadmap. So that was some great information that you just gave.
Very good point. That fear is a real thing, but we can't stick our head in the sand because, and I tell my clients when they see these numbers, I'm like, listen, it's gonna freak you out. But we're going to have a plan to get there. But when you're playing darts and you're aiming for the bullseye, if you just hit the board, you still get points. So even if you can't hit that number, maybe you got to work an extra 5 years. Or heck, some people are not too sad if they need 2 million and they're at 1.5, right? We're not going to cry, but at least we got something. So the goal is to look at it, like you said, Brother Carl. So let's talk about business mindset. Let's look at some of the stats for small businesses. There's over 32 million small businesses in the United States. We make up a big portion of employers and a big portion of business representation in the United States. The The other thing is that 75% of those small businesses are considered micro businesses. So what is a micro business? A micro business is a business that employs 9 people or less. So it's you, yourself, I, and maybe a couple other people, but definitely no more than 9. So once you get to 10, you're considered out of the micro business sector. But what's important about that is most of these businesses are starting with somewhere around 10,000 in money, in a capital to start their businesses. And then for the smaller businesses, they're starting somewhere around 3,000, right? So it doesn't take a lot of money to start a business. And what we're here to talk about is definitely funding that. And one of the ways that you're able to fund that, and we're going to talk about that in a second, is by making sure you're established as a business entity, but also using your previous 401k dollars to fund your next business. And we'll get into that in a second. But just wanted y'all to see a little bit about what's going on in the United States. And during COVID, those numbers shot up. I mean, astronomically. Forbes had a article out that said we would probably go to 50% self-employed or 50% contract workers in the next 10 to 15 years. That's where we're moving to. But one of the things from a mindset perspective that I want to make sure I cover, and I teach this in high school, right? I tell people the most important decision that you're probably going to make is not who you're going to marry, where you're going to live, but it's going to be how you make your money. And for us on this call, many of us, we're either thinking about entrepreneurship or we are entrepreneurs. So regardless of where you are, there's some things that I want to make sure that I drop in your brain. No matter where you were born, United States, Canada, Africa, Europe, Asia, doesn't matter. There's only 4 ways to make money. And I couldn't believe it when I saw this. I was like, only 4 ways? What do you mean? There's 1,000 ways to make money. There's only 4 ways. Everything falls into these 4 categories. And I'll tell you in a second why I wanted to cover this. So you can be an employee. And as an employee, you have a job. You sit down at this desk. It doesn't matter if you come in early, stay late. You make whatever that job pays. Now, I've seen people poo-poo employees, talk crap about having a job. Listen, I know people, I have clients that like going to work 9 to 5, sit at their desk, they clock out, they leave, they got their weekends or their summers free. There is nothing wrong with having a job if that's what makes you happy, right? Some of us decide, well, I don't want to work, or I want to work but still do something on the side. We decide, hey, I want to have my own business. I don't want to, like Brother Riley talked at the beginning, I want freedom. I don't want to be my own boss, right? But when we're thinking about this, that means that you're self-employed, which means you own a job, because you don't make money unless you're there. It sounds really good. Oh, he's a doctor. She's a lawyer, right? She was a basketball player. Well, if I didn't bounce a basketball up and down somebody's court, I wasn't getting paid. A doctor ain't cutting somebody open or examining somebody, they're not getting paid. A lawyer in the court ain't in the courtroom, guess what? Ain't no money. So that means that you have to show up in order to get paid. So we actually don't have businesses, we're self-employed. And I correct people and myself on that all the time. But for the sake of argument, we'll say we have our own businesses, right? Because a business means that you have a system that works whether or not you're there. You go to,
I say exactly. You can step out and it's still running.
Exactly. You go to Popeyes, right? And you got a problem with what they got, the chicken sandwich, right? And you say, hey, they didn't make this right. You're not going to talk to the owner. You're going to talk to, heck, you won't even talk to the manager. You're going to talk to the shift lead. The manager in the back ain't coming outside. So that's a business. You go to a hotel, you pull up in your car, the valet take your keys, you go check in, they give you your room key, the guy take your bags. You do not see the owner. This is important because as self-employed people, we want to be having conversations and thinking about, how do I go from self-employed to business? For me, it's franchiseship. I have to build a franchise in order for me to get to the business portion. Until then, I'm self-employed, right? Lawn care specialist. You know, I have a couple that have transitioned to that business side where now they have crews that go out and all they do is kind of go and get new business and give it to the crew. So they're not physically cutting the grass anymore. We want to make sure that we're scaling our businesses to the point where it's actually a business and runs without us. And then the other way to make income is to be an investor. And that's what we're here to talk about. If you don't learn how to make money while you're sleeping, you will work for money for the rest of your life. You cannot save your way to wealth. You have to invest your way to wealth. Right? Brother Carl is in commercial real estate. He knows all those kind of conversations about building wealth through real estate. There, you have to be an investor in order to make that money work for you so that you can transition. So whether you're an employee, you better be an investor. Whether you're self-employed, you better be an investor. You own a business, you still better be an investor. COVID could happen and shut you down. Somebody might decide that they want to buy your business. You got to do something with the money to make sure that it lasts you. The money that you're making, eventually you want to transition out. It has to be invested. There's no way around investing. Most people, if asked the question, which side of the cash flow quadrant would you want to be on, the employee or self-employed side? I beg to say at least 99% of people would be like, well, I want to have a business and I want to be an investor. Duh. But 99% of people are on the right side. So we have to start thinking about how do we get from the right side of this quadrant to the left side of this quadrant. And that's part of the conversation today. Because success, when we're entrepreneurs, people like Brother Riley said before, this is great. I work for myself. This is awesome. I'm making all this money and da-da-da-da-da-da-da. Most of the time it's lies. It's to sell you something, right? To make it look so good. But we think that success goes like this. You know, it's funny. I played professional ball. I thought once I got my licenses, I was just going to put my shingle on my business and voila, right? That ain't what it looked like at all. I fell on my face for a couple of years. I was telling Brother Riley, I was going to share my first entrepreneurship story. I knew nothing about business, but I knew I wanted to have a business. My daddy was an entrepreneur at heart. So my first business was a wing deli in Jonesboro, Georgia. Okay. Because Atlanta needed more chicken wing spots. And it seemed like a great deal. I thought it was an awesome way. And I thought it would retire me. So while I was playing, I was like, well, let me, open this restaurant so that I don't know why athletes like restaurants. It just sounds good, right? Let me open this restaurant. Well, I was jumping off the plane from Turkey, like literally landing in Atlanta from Turkey, playing and coming in during my 2-week break to shake chicken wings to save money on payroll. That don't look like this. And by the time I looked at the numbers and decided to shut that thing down, I was already in and had lost almost $180,000. So that squiggly line, right, is what it looked like and felt like, right? But on the outside, when I would tell people, oh yeah, I got a wing deli out in Jonesboro, they'd be like, oh, that's so awesome. Because it looked like this. So we have to be prepared for that. There's 4 tips. And if I could go back to myself that bought that, that restaurant, first of all, I wouldn't do it. But if I did do it, there's some things that I would want to talk to myself about. So 4 tips that I talk to my small business owners about. The first is you got to be organized. Get organized. When I sit down and I'm talking to clients about, hey, what's your annual revenue? Where's your P&L statement? A what? Okay, this is a problem. How is your business organized? Are you a LLC, a S Corp, a C Corp? How do you file your taxes? Are you LLC and file your taxes as an S Corp? Like these are the things you need to know. Your receipts, your vendors. That part is more of an accounting thing, but we have to have that because I can work with the accountant to make sure you're set up correctly. But if we're not organized and we don't know the business of our business, it's challenging for people to help us. We can't apply for SBA loans. We can't hardly do our taxes right because we're not organized. The other thing is what I share is to narrow your focus, especially if you're a solopreneur and you are working for yourself and you have something specific and it's service oriented. Narrowing your focus is so helpful. It sounds counterproductive, but it's actually very helpful. I can do a lot of things. Y'all saw my licenses. I can do college funds for parents and grandparents. I can do rollovers for 401ks. I can do small business 401ks for large business 401ks. I can do life insurance. I can do annuities, but I would not sit there and blurt all that out to someone. I tell everybody, hey, listen, I work with serious people with serious money who are serious about retirement. So I focus on retirement and investing. That's my focus, but I can do a lot. If you're in lawn care, you can't say, well, I just cut everybody lawn, right? Maybe you want to say, hey, I bring beat up lawns to life. I don't know how the terminology, but you want to have something that's narrow, that's specific to you. When I meet people who have their own businesses and I say, well, who's a great referral for you? I meet people all the time. Who are you looking for? Oh, I can help everybody. Well, even though that might be true, that doesn't help people do the next thing, which is make it easy for people to use your business. You can't be investing if you're not making money, right? So you got to make it easy for people to use you, which means that you're organized. You have a narrow focus. So if I look out my window and I say, oh, my hedges are messed up, and I know there's this guy who's the hedge master, I know who to call, right? Now, when the hedge master get there, he's going to upsell me for everything else. But having that narrow focus helps people make it easy for you. Easy to use your business. And then build a team or tools. Everyone can't afford to bring in a marketing person or have an accountant, especially if you're just starting your business. There's tools out there. Invest in those tools. My favorite thing to share with my clients is Mint. Mint.com is free, right? You can go in there and track almost everything and set up budgets and set up different spending, track. Like you can do a whole bunch of stuff in there for free 99, right? And so there's a lot of free resources, but there's also some things that you're going to have to spend a little money on, but it's worth it to make sure that your business is streamlined. Okay, so now we're going to get into managing the money. I'm going to take a quick pause right there. I didn't do like specific deep dive. I didn't want to put y'all to sleep and all that. But if there's something inside of there that you want me to kind of speak on again, I'll take this moment to pause before we get into managing money.
Money wakes me up.
Hey, hello.
I'm sorry. Also, QuickBooks, because I'm a person, organization is not my strength. Mm-hmm. Beyonce has to be a CPA, but QuickBooks has an app also to help you get organized as a small business, and it keeps your receipts, your mileage, everything, and they have their own app also. Yeah, you pay for it, but that's a write-off too if you're a small business, because that's part of your business as well.
Exactly. There's so many things. There's really not an excuse anymore to not have these things lined up because there's so many resources. Was someone else saying something?
Yes. My name is Ado, and I want to get your thoughts on investing. And I think when I talk to other people and friends and professionals and people that are educated and with great jobs and stuff like that. I know you mentioned a few minutes ago about the cash flow quadrant. Mm-hmm. And when we talk about the investor, and you were saying that people have to be invested in order to make money, but that's such a hard concept for me, and for a person trying to help somebody else and say, okay, you need to save some money, you need to put some to the side, you need to invest a little bit in the stock market so that you can grow your money and those kind of things. But those same people say, well, man, when that stock market goes down, I suffer. And I say, okay, everybody suffers when the stock market goes down. Right now in the last 2 months, maybe 3 months has been horrible as far as the stock market is concerned. But you're still there. I'm still there personally for the long term. So I can't convince people that it's still a good piece of your financial portfolio. So how do you go about that? How do you try to ease the pain, if you will, as far as the thought process of getting into the stock market and, hiring a financial planner that's going to help you manage your money? I know that corporate America and these 401k plans have a certain list of options for you to choose, and they work pretty good. But then once you leave that particular job, they don't understand the rollover piece that you can roll that 401k over to an outside financial institution like E-Trade, Morgan Stanley, whatever the case might be. So it's just very difficult to convince people that this is something that you really need to take a look at.
Very good point. And we'll get into some of the options. I didn't put a lot of the investing specifics in here just because I wanted to do a general approach. But let me touch down on how to help people understand the market, right? So first of all, there's a difference in how you're investing. Some people like funds. I'm a mutual fund fan and ETF fan. I use a lot of, for my higher net worth clients, we're using a lot of ETFs and what they call SMAs, and I won't get into all that, but those are different types of investments. I like funds because you buy multiple companies.
Yep.
And you spread out your liability, right? But the way I explain the market's up and downs is I tell people is the market is predictable. It's predictable. It goes up and then it does what, Ado? Yeah,
it comes down.
And then after it goes down, it does what?
It comes back up again.
And then after it goes back up again, what does it do?
Yeah, I tell them it's a heartbeat. It's just like a heartbeat.
It's a heartbeat. And when your heartbeat is no longer beating and it goes, and
right,
your money's dead, right?
Right.
So we want to make sure our money is alive. It's not what the market is doing and when it's doing it. It's the matter of your time. And so if you're working with an advisor, what I do is most of what I do is not even managing money. It's managing emotions.
Right.
And how people are feeling.
Correct.
So how I explain it is, okay, Ado, if you bought a house for $300,000, okay, and the market tanked, and the housing market tanked, and that $300,000 house right now on paper is about $190,000. Did you lose any money?
Not until you sell it.
Not until you sell it. So that's how I explain the market. On paper, it looks like you lost. Like when people say, oh, I suffer when the market goes down. Do you really? Because what you would want to do when the market is down like this, I'm having conversations with clients who are calling me to put more money in because the market is down. People buy houses when the market is down. Oh, I can get a $300,000 house for $180,000. Well, it's the same thing. I can buy Amazon and Facebook and Apple and all this at a 35% discount. Oh, because it's going to do what?
Go back up.
Go back up. And so that's how I explain investing. The other thing that I talk about also, Ado, is let me ask you a question. If you took $10,000 and you put it in a mattress and just waited 3 years, did you lose any money?
Yes, you lost money on the growth of that $10,000 if you had put it into some kind of a financial management account.
No, you lost money because that $10,000 doesn't spend like $10,000 anymore.
Right.
That $10,000 is now worth more like $9,500 because gas went up,
inflation,
milk went up, everything went up. So if your money is not at least keeping pace with inflation, you're losing money every year. And so once we start thinking about that and having those kind of conversations, it opens people's minds up because nobody teaches us this stuff, Ado.
Right. That's
Right.
right. I agree.
These are not conversations I had in my household. My mama said save money. So I would save money and then I would be like, oh, I can go buy something now. Okay, now save money again. Oh, I can go buy something. So these are really important conversations that you're having. So I commend you. Are you in financial services?
No, I have a degree in accounting and a degree in, business management, that kind of stuff. And I do understand the value of investing, and I've done pretty good with that, even when I was working, and then I rolled things over to separate management companies, and so that has kind of worked out for me. And I understand it, but I just can't get some friends and people that I meet to actually understand that you have to take a risk, that the market is a heartbeat. You're going to have your days when you're up, you have your days when it's down, but then they only look at the downsides of it. They only look at, okay, my portfolio lost $10,000 this week.
But you don't need it right now, right? Those are the conversations. Are we selling? Do we need the income right
now? That's what I can't sell to them. I said, okay, but it's going to come back up in a week and a half, maybe 2 weeks and a half. It'll be up by 15,000.
So you just have them call me. I'll
okay. I got you.
Sometimes we can bang our head up against the wall.
I know.
I just can't get you to listen. But no, there's some tools and resources that I use from an education perspective to try to help people understand, because if you don't have these conversations and you don't have a deep understanding of how it works, then all you're looking at is the numbers of the loss, and you're not looking at the returns. And if you don't participate, all you doing is watching it anyway. So when people be like, oh, the market is down, I'd be like, oh, how much money you got in the market? Oh, I'm not investing. I'm not. Well, then why are you worried about it? Right. Like, what's it to you, right? So I'll make sure I'll have my information on the back end. So if you need, I can send you some resources that you can share with people that might be helpful as well. So all right. Thank y'all so much for your input there. That was a great conversation. So let's talk about managing money. And again, these are just surface tips to be thinking about, and things that I've encountered when working with small businesses. Believe it or not, people don't track their income. I fall short sometimes because I'm like, oh, where'd that come from? Right. So understanding where the money's coming from, where's your high revenue coming from, so you can focus on those things, is something that oftentimes we don't do. It's just, okay, the money came in and I paid the bills. We're not really tracking it, and that's important. And that's a downfall that I see, because if you were audited, if you had to prove something, you don't have a track record for like where your income's coming from and where it's going to, and keeping an audit of your expenses. This is one of the things that, I fell victim to a couple of times, because I have this service and I have my software and I have my marketing person and I have this and I have that. And sometimes I've lost track of that. One of the things that I do that's really, really corny and very easy, but works for me, is I put bills in my calendar. So a week before, I know, hey, this bill is due. Hey, that's due for this. Hey, that's due for this. And that's my tracking system, because my brain is not a spreadsheet brain. I look at a spreadsheet and I start going like this. As far as like bills and stuff like that, I like to have it tracked differently. But you got to audit those things, because sometimes you're not using things anymore. Or I'll take a look and I'll say, hey, I have this particular service that I thought I would use for my clients, that would be good for my clients, and I'm not really using it anymore. Let me just, take that off. It's the same thing on your personal finances. I can't tell y'all how many times I forget that I bought something on Amazon Prime and I'm like, wait, where's this $6.99 coming from? Right. We got to be auditing constantly, at least every month, where you're paying out money as well as where the money's coming in. And this one is a big one. Small business people, you got to have a separate bank account. You have to have a separate bank account. It doesn't have to. Now, I've heard people say, oh, it needs to be at a different bank. I don't know about all that. Depends on what you got going. But having a separate account, period, is so important so you can track just your business income and you're not commingling your funds. If you're in a position where you can now pay yourself every month, do that, please. I don't care if it's $200 a week or $200 a month, whatever it is, track the paychecks that you give yourself, because now you can prove income. And me and Brother Riley were talking earlier about people not wanting to track their income. But the reason why that's important is because now if you go to buy a house, you need to buy a commercial building for your business, you need to buy a car, you need to do whatever, they're going to want to know where your income is. And if you don't track it or have some type of proof of income, they're not just taking your word for it anymore. So you want to make sure you're doing that. And then protect your business. Protecting your business means making sure you have it in the correct category that it needs to be in. Is it a sole prop? Is it LLC, S Corp, et cetera? You need to be working with an accountant or a tax professional if you can, but everything is online. So you can take the time, from 10 o'clock at night to 11 to do research, right? You also protect your business through, I tell all my small business owners, you want to have a key man policy. You want to have some insurance on your business. Because if something happens and you have a business partner, if me and Ado are in business together, I like doing business with Ado. I might not want to do business with his partner or his kids, right? I'm doing business with him. So there needs to be money in place where I can pay off his portion of the business to the family. And in addition, you have to have an operating agreement when you have partners. Oh my God, can I tell you how many times there's not been agreements in place? Something happens to one of the partners, either there's a falling out or a partner passes or whatever, and there's no agreement. So now you're in court with the family, and yes, it happens, or the business has to dissolve because it cannot function the way that it was functioning before. So that's really important. And as I mentioned, and y'all see this running through most of my advice, you need to get accounting help. Whether it's, as Brother Carl said, through QuickBooks or some other service, or actual hiring an accountant, is actually not as expensive as you think. Some accountants work on a monthly basis. Some of them will do your books quarterly. There's things of that nature that are out there, and people are usually going to help. The other thing is understanding that, hey, as a small business, if you're filing as a small business, you need to be paying your taxes quarterly as well. And that's another reason why you want to have an accountant or a tax professional help you with that. But you can do it yourself. You just need to put a little time and effort in. All right. So before we get into the different categories of investing for your small business, I want to talk about a few things that have been coming up a lot in conversation, and I want to debunk some of these investing. I call them these mythical investments, right? The first one is be your own bank or infinite banking. It's been coming up so much. I'll get on TikTok, I'll get on a social media platform, and these people will be like, oh, put, $300,000 into this infinite banking, and you can borrow your own money and you get dividends and you get da-da-da-da. This is literally another way for life insurance companies to take money. Okay. There's two types of companies. You have a mutual company, and then you have a stock company. Life insurance companies are mutual companies. That means that we all own a piece of this company through the policies that we buy. And then that company takes the profits and circles them back through and call them dividends, but they're really not true dividends. Like if you bought Primerica stock, for example, Primerica stock pays dividends. That's a stock dividend. This is a different type of dividend. So what happens is they overcharge the people who buy the policies and then give them a little bit of the money back. But you're literally handing your money over to an insurance company, and then you have to borrow your own money with interest and pay it back, or you lose that death benefit in a lot of areas. So read your contracts. If you want to be your own bank, I'm getting ready to show you a way to do that where you're not giving it to an insurance company. And then crypto, Bitcoin, NFTs. I am not anti-crypto, Bitcoin and all of those things. What I am against is people convincing people to put their retirement dollars into things that are a whole lot more risky than mutual funds. I've seen people lose 20, 30 years of working because they're chasing a quick buck and they're chasing getting rich. Does it happen where people put in $1,000 and wake up and they're multimillionaires? Absolutely, it happens. But the chances of it happening are very small. So with every type of investing, brother Ado was saying before, you got to be in it for the long haul. And so if it's your gambling money and it's your extra money and you want to throw some money into these different things, then do that. But don't risk your foundational money. Remember, we talked about those bookends, right? If something happens, something like COVID happens again, or you have a downtime in your business, do you have money set aside to make sure you can weather the storm, and making sure that you're funding your retirement, because you're not going to work at 70 like you did at 35. I've seen some people out there still working, but your back not going to hold up the way that it does at 35. So we want to make sure that we're doing that. Alrighty, so we're going to get into the small business retirement options. And this is where it gets a little bit more technical, but hopefully I'm able to explain this well for you guys, and you'll get some good stuff out of it. So 401k, what does that mean? It's actually a code in the IRS book. So if you open the IRS code book and flip to 401k, 403b, right? It tells the IRS how to tax you. IRA, individual retirement account, another code that tells Uncle Sam how to tax you. A Roth, one of my favorite things, thank you, Senator Roth, for creating this, tells the government or Uncle Sam how to tax you. Where people get confused is that these are not actual investments, okay? They are investment vehicles. They hold the investments. So you think of it as a box, and that box has a label. That label says pre-tax, post-tax, capital gains. It tells the government how to tax the investments inside of it, okay? So looking at the options for small businesses, one of those is 401k. So when you have employees and you want to provide a plan for them, or if you're working for a company, oftentimes they'll have a 401k. So any size business can use this, but it's really better for people who have a lot of employees and want to provide benefits. And it gives you some control. So they don't have a lot of maintenance charges, and there's flexibility. So it might say, hey, you got to work here for 3 years before you can, use or access the 401k. And hey, we're going to match up to 3% of your, what you put in here. But the reason why 401k plans are really attractive is because you can put up to $19,500 for this last tax year. That goes up this year to $20,500. And then there's a catch-up provision if you're over 50. So that's important. And then the other thing is that these have a Roth portion, and we'll talk about Roth and IRAs in a few minutes, but this is for the larger company for the most part. This is where I talk to people who say, hey, I don't want them taking my money. Well, if you have your own IRAs, you'll see in a minute, you can only put $6,000 a year in that thing. But if you're doing it at work, you can put up to $19,500, plus you're getting free money when your employee matches your dollar. If you are an employer and you're offering this to your employees, this is helping people retain employees, because people want benefits. So having a 401k in place actually incentivizes your employees. This one is specifically for the small business owner. And I think this is one of the sexiest investment accounts that you can have as a business owner. And I'll tell you a little bit more after I explain what it is. So you have an individual or a solo 401k. This is just for people who don't have employees. Okay. So you don't have an employees, maybe your partner is working with you. That doesn't prohibit you from having this type of plan, but it has the same rules as the 401k, but they're super inexpensive. And you can still put up to 19.5 into your Roth portion, which is what a lot of my clients do. But the company, your company, can profit share or match your contributions up to $58,000. So people who have high revenue businesses, so let's say you're making at least like $250 a year, you can actually take up to $58,000 next year to be $61,000 and put that into a retirement account. And that's a tax deduction for your business. So you get the tax deduction for your business. You get the tax deduction from your personal income because you're contributing to a 401k. Well, it's also a 401k, which means that if you need revenue or you need capital, you can actually borrow from your 401k and pay yourself back. So remember, we talked about that infinite banking and giving it to the insurance company. Well, if you have your own plan and you're putting money away, or let's say, like I have a client now that just left Coca-Cola. He has about 800,000 from his Coca-Cola. He's starting a consulting business. He's going to open up a solo 401k, put the $800,000 in there. Now, if he hits some bumpy road as he's building his business, he can access up to 50% of that and borrow it and pay it back to his 401k. To me, that is like one of the nicest, greatest things for people, especially my clients who are in real estate. They use that for acquiring property and putting it back. That's important because you're not paying taxes, you're not paying penalties. So those are the things that make this really good for the entrepreneur. So if people are going from corporate into opening their own business, the solo 401k keeps you from having to pay penalties and taxes for pulling the money out. It also gives you continued access to investing and you own it, not the old company. Another option is what they call a simple IRA. It's one of my least favorites because you can't put as much money away. You can put up to 13.5 in it, but you have to match and you have to put money into whatever you do for yourself, you also have to do for your employees. So I'm not as much of a fan of this, but some companies do have them. I see them and I'm competing to actually replace some of these for them. And then one that accountants use a lot because they're not familiar with the solo 401k is the SEP IRA. It's a simplified employee pension plan. So basically, this is better for small business. It's all the employer though. So the employer can take 25% of the compensation and put it into this plan, which gives them higher deductions. There's that 58,000, 61,000 going into next year, which is great because you can put more money away. But again, you have to do it for all of your employees. You can't just do it for yourself. Like in a solo 401k, it's just you. So if you have a SEP and you bring on an employee, you have to also contribute to them. So if you're not a high revenue business, this plan wouldn't be great for you. You want to make sure you're accessing the solo. And then let me dive a little bit into the difference between the Roth IRA and the traditional IRA. For some people, they're saying, hey, Kia, I'm not a high revenue business. I can't imagine putting $58,000 away a year or $19,500 a year. That's just not where I am, but I want to be doing some type of retirement for myself. Well, you got the Roth IRA option and the traditional IRA. The Roth IRA, in my opinion, is one of the best ways to save for retirement if you're not needing to put a lot of money away. And the reason why I say that is because it's post-tax, which means if you made $1,000 and you put $500 into this vehicle, you're still paying taxes on $1,000. Well, that don't sound good, Kia. Here's the thing. As that $500 grows and you keep putting more money and more money into it and it grows, when you get ready to access that money at retirement, all of it is tax-free. Zero. It also has loopholes in it. If you know an advisor who knows the loopholes, that actually gives you access to it sooner, because if you take it out before retirement, you have a 10% penalty You don't have the tax penalty though. As long as you've had it for 5 years, you don't have the tax penalty. You'll just have a 10% early withdrawal penalty. So there's loopholes for that too. The wealthy people always put loopholes in there. So that's important. The traditional IRA is for the person who says, well, Kia, I do want some type of a tax reduction on my income. So this is good for that. And that means if you made $1,000 and you put $500 into your traditional IRA, you're going to pay taxes on $500, not the $1,000. However, when you hit retirement age, Uncle Sam is going to go, hey, need you to run me my taxes because you didn't pay him 20 years ago, right? He's always going to want his tax dollars up front or later. The reason why I prefer the Roth over the traditional IRA for the business owner is because of legacy planning. So because the Roth IRA grows tax-free, you do not have to access the money and it transfers to your beneficiary tax-free as well. The traditional IRA, we're living longer, right? So when you turn 72 and a half, Uncle Sam comes knocking on the door and says, hey, you're getting a little closer to kicking the bucket. I'm gonna need my taxes. I want them now, right? And so, and when you pass on and that IRA goes to the beneficiary, they also have some tax liabilities there. So Uncle Sam is always going to get his money no matter what. And so those are the differences there between those two accounts. So I'm going to pause there because I know that was a lot of information. So what questions do we have?
Okay, my first question is, so in a traditional IRA, you're taxed twice or multiple times, if you will, especially if it transfers to your survivors. They have to pay taxes on it again, as opposed to a Roth. You pay the taxes up front, and when you withdraw it, you don't pay any taxes at that particular point in time. So is that basically the difference between the two as far as the tax liability is concerned? One, you pay taxes one time, the other one, you pay taxes maybe multiple times.
It wouldn't be multiple times. It would, well, multiple times because every time you take the money out. So let's say you have $1 million and you're taking the 30,000 out.
Right.
Every year you're paying taxes on that 30,000.
Right.
Right. So remember that first chart we talked about accumulation, protection, distribution.
Yeah.
So what I like to balance those two things out because if you're 72, if you can wait until 72, you're not working as much. So your tax liability is a little bit lower, but for sure, every time you tap into it, you're paying taxes. And when it transfers, so let's say you had $1 million in your IRA and you left it to your daughter. And over the time that you used it, it had gone down to 600,000. Well, she would still pay taxes on that 600,000, or she could roll it into her own IRA. It's a beneficiary IRA, but when she turns 72, she would still have to take the money out and pay taxes.
Right.
On the Roth side, you're correct. You do not pay taxes. It's completely tax-free growth, which is why even in the solo 401k and the 401k, it's so attractive because you can use the Roth portion of that. Mm-hmm. And you can put up to $20,000 in there in the business 401k versus your individual IRA, Roth IRA by yourself, you can only do 6,000. Right. So people like that solo 401k because they can put $20,000 away versus 6,000, and it's all tax-free growth. Mm-hmm. Good question. Yeah. Any other questions about that?
I saw something, I think it was like the first one, it says something about under 50. Mm-hmm. And I didn't know if it was over 50, that was a different amount. It was a solo and it had something about a plan for under 50. I don't know if you can go back.
Well, under 50. So once you're over 50, you have I'm sorry, say that again. I missed it.
Not under 50 anymore. So that doesn't pertain. I just want to know about the over 50 people.
Right. So over 50, you have a provision for catch up. They call it a catch up provision. So typically you can put an additional for some of the accounts, it's 1,000. For one of them, it's an additional 3,000. But you can put in an additional, let's just call it 1,000, because I know that for the solo, you can put an additional amount of money away over what those minimums are.
Okay, great.
And I see, Riley, I see a couple of things in the chat, but if I click on the chat, I'm going to end up coming out of my presentation. Are there questions in there?
Oh, yeah, muted.
No, just comments.
Okay. All right. I'll see it in a second. Any other questions about that?
Yes, good morning. Good morning, Soror. Good morning, Frats.
Good morning.
Morning.
Listen, I was calling to find out in reference to the 401k plans that you have at work. Is there a possibility you could take some of that out and invest it, or is that something that the company needs to do?
So it depends on your age. So if you are 55, you can do what they call an early withdrawal, and you can roll that money out into your own IRA and invest it. You know, if you have an advisor that's helping you invest it how you want, or if the robo people, I think, can do it too, I'm pretty sure. So it depends on your age. But if you are working for an employer and you're under 55, then they have complete control over what investment options you have. So outside of your employer for additional investing, I suggest that people have that Roth on their own outside of their employer. Did that give you the information you needed?
Yes. And one more thing. So I missed a little bit because I'm walking, but with the other investment, instead of taking out a 401, would you advise to go ahead and do an investment outside of your job if your job have something else besides the 401?
Like what, a 403B?
Yes, the 401(3). Yes, 401(b)(3). Yes, that's it.
403B. Okay,
Yeah.
so those 403B is my least favorite retirement, just because they invest in annuities and it's usually not as much of a growth option. So I suggest those same things, having a Roth IRA, or if you need the tax deduction and an IRA outside of your job, there's a maximum you're allowed to put away. So the difference you can put into something outside of your job. I do suggest always to take up to at least whatever your job is matching, put that in the job 401k or the job investment account, and then have something outside of it. One of the things that I suggest for my clients is a lifestyle fund, because oftentimes people who are maxed out at work don't want to have to worry about when they can access the money. So you can actually invest in a portfolio, and it doesn't have to be in a retirement account. It could be in, remember, I don't know if you were here for when I talked about the boxes. So the 401k box is labeled for the IRS to say, hey, this is pre-tax money. The Roth IRA is labeled, hey, this is post-tax money. And then you have what I call lifestyle investments or portfolios that say, hey, this is capital gains. I love capital gains. If y'all remember, the 45th president of the United States said, hey, I pay taxes. I pay millions of dollars in taxes, but when his income tax came in, it was like he paid like $17 or something crazy. I don't remember what it was, but that was because he paid capital gains. So if you make 1,000, it's not the same as income. You go to work and you make $1,000, Uncle Sam is going to take somewhere around 22%, 22 to 30% of that money. You take money and put it in the market and you make $1,000, Uncle Sam takes 15%. You make 1,000, you give him his 150, and y'all done. Business over. And that 850 continues to grow. So capital gains is something that I really want my people to fall in love with, because as you make money, you're taxed at your making money has a lower tax liability than the money you go to work and work every day for. It's insane. So if you want, wow. So if you want to invest, you can invest and have a portfolio where you're putting money away. And then depending on how your portfolio is arranged, so working with an advisor helps you figure out what your what your risk tolerance is. So I put together portfolios and say, okay, well, you're kind of conservative. We'll stay here because you don't want as much of what Ado was talking about with the up and down. You need a little, a little less. Or I got 70-year-olds who are aggressive. They're like, let's roll the dice, right? So having a portfolio, but it's liquid. So when you take your money out, all Uncle Sam cares about is, hey, you invested 10,000, you made 5,000. We just want our 15% on that 5,000, but that's all. You don't have any liabilities there. So that's my suggestion. Max out what you're getting matched at work. And then if you want something more liquid, get into an actual portfolio or set up a Roth so you have some tax-free growth. Great question.
On the rollovers, I've had to encounter that a couple of times because I moved the money from corporate America when I left to a more managed fund with like E-Trade or
managed accounts.
Managed accounts and those kind of things. Just be aware that when you roll it over, do everything you can to roll all of it over, because if you take some out, the penalty in taxes for taking it out and not rolling the entire amount over might be a little bit more than you want to take at that particular point in time, because you will pay a penalty if you take any of it out. So just make sure you roll over the entire amount. And one of those situations, just leave it alone. Just roll it over, put your plan together with your advisor, and let it grow and work the plan. Do not take 10,000 out of it just to take a vacation or anything like that, because that 10,000 is going to cost you.
Absolutely, Ado. That's such a good point. And that's why I do my best to avoid the money coming to the client. Because if you see that check and you over and you're like, oh, I'm just going to paint you a little bit off. Well, you take $10,000, you're going to be paying about 30 to 40% of that in taxes and penalties, right? So you end up with about 5,000 or 6,000 when you look at the math on it. So very good point. Every time money moves, there's some type of transaction fee attached to it. Even when you roll it over, you're going to be paying some type of sales charge, which might be somewhere, depending on the amount, can be up to 5%, right? But you're not doing the taxes and penalties. So it is better to roll it over. And that's what I talk to my clients about when we're setting up the solo 401ks. You're not doing the taxes and penalties, which you're going to save on that as if you liquidated it. So like I had a client, we used this strategy to help pay down all his debt while he was building his business. We rolled it into a solo 401k, all of it, borrowed the money to pay the debt down, and then he paid the money back to his 401k. So there are some strategies there that you can employ if you do need some of the money that'll help you avoid what Mr. Ado was talking about.
Yeah.
Okay. Any other questions? Awesome. Alrighty. So I just have a couple of suggestions. As a small business owner, I think one of my favorite books that I suggest is that people read a book called The E-Myth.
I love it.
It is, oh my goodness, it just really, I need to reread it again so I can learn how to delegate. But the book just kind of talks about how most of us have a passion for something. You know, I absolutely love what I do. Like, this is the best thing. I go to bed every night knowing that I did good in the world, right? But let's say you're a baker and you love baking. Well, you don't want to run the cash register and sweep the floors and do, so you have to learn how to structure your business where you can just do what you love and figure out a plan for that. And this covers that, and it covers it in a very good, entertaining way. My other favorite book, and I have my clients read this, is The Millionaire Next Door, because a lot of people think getting wealthy or being wealthy, you have to have a lot of money and you're starting with a lot of money. It has been statistically proven that the majority of millionaires got their $1 million+ through working and saving and investing.
Yeah. Cleaning.
and how they live, and how they, it's ridiculous. I read that book about how they really live, not what people think they live.
Oh,
They don't blow their money.
They do not blow their money.
hey, Nakia, do you know what's the number one vehicle for most millionaires? What's the most common vehicle for millionaires?
It depends who you talk to. Some people say real estate, and then some people say investing in the market.
No, I'm saying what they drive.
What they drive?
Yeah.
F-150? I don't know.
Got it.
Toyota, Honda.
F-150. F-150.
That's the vehicle of millionaire. Oh, you said what they drive? Okay.
Yeah. It's the F-150.
Yep. And it's funny.
A lot of those people have land.
Mm-hmm.
Farmers.
Land runs everything. Everything.
Absolutely.
Everything you have, and land will not be recreated.
God not making no more.
No. If you can ever get your hand on a piece of land, hold it. You can do a lease option, because I work with Popeyes, and they will do a lease option with someone that owns the land that's not selling the land, and they'll pay them several $1 million for 2 years. And then once Popeyes leave, they continue making money over and over and over and over. Yeah. Land banks.
It's a beautiful thing. And I work with a lot of realtors, helping their clients as well. So it's like a sweet spot in understanding that, as Brother Riley said, you would never know how these people live, that they're wealthy. Somebody put a picture up of, I can't remember who it was, Mark Zuckerberg or Elon Musk next to somebody. I can't remember who it was. And this person was labeled head to toe, and they were like worth 1 billion and he's worth like 36 billion or something like that. And most of the time, the wealthy people are the people that don't look like it.
Oh yeah.
So it's important for us to
always, he's in black, and he always wore just, the jeans and the t-shirt.
And some dirty flip-flops.
I met Bill Gates back in the 90s. That's when he was still running Microsoft. And I met him at a conference in Vegas. And he was just walking around, looking at all the vendors and see what kind of software we had to sell and that kind of stuff. And so he walked up, he just had on a little dull pinstripe gray suit. I mean, it was just straight from
he had a suit on that day.
It was from
no khakis
on that. Right. It was straight from JCPenney. It was not a Brooks Brother or Couture or nothing like that. It was
so y'all get the point, right?
Yeah.
Sam Walton, Sam Walton always had, overalls on, and Walmart actually, that came out of Bentonville, Arkansas, but Coca-Cola and Delta came out of Louisiana. Yeah. Delta came out of Louisiana. Most people don't even know. They think Delta came from Atlanta, but Delta actually came out of Louisiana.
Yeah. So I'm gonna move on through because we're pushing up against time right now, but y'all get the point for The Millionaire Next Door, right? That's a great book I have my niece reading it right now so they can understand. The other book that I love, and this was something that changed my life from a mental perspective, is a book by Napoleon Hill called Outwitting the Devil. A lot of people like his book, Think and Grow Rich. However, it was a little nebulous to me. And for me being a person of color as well, there were some things that I fought with in that book. But Outwitting the Devil for me was by far one of the greatest books that I've read to help me think about how I focus and how I stay on the path that I know that God has me on. And then the other thing is Mr. Google. Look it up. Stop letting people tell you stuff and go to page 2, right? Because when you Google something, the first 6, 7 things are ads, or they're sponsored, or people paid for that space, right? So go all the way down to the bottom of the page, or go to page 2 and really deep dive into whatever it is that you're wanting to find out, because that's where the people who aren't selling something to you usually are, or the information is just there. So you have so many resources now as a small business owner So we have to take advantage of them. And so those are some small things that I think are helpful and were helpful for me. So I'll pause there. That wraps up the information I have to share today. I know we've had some questions already, but if there's anything else that you guys want me to touch on before we close out, this is the time to make it happen.
Well, just about the book, E-Myth, the thing I loved about the E-Myth book is about, one thing is to know your product and be an expert in your product, but knowing the business is two different things.
Mm-hmm.
And so a perfect example is McDonald's, about the process. It's not that McDonald's have no great food. It's their process, getting you in and out, and that's all they focus on, was the process. Because when the guy brought the vision from the guy who actually started McDonald's and brought the process to it, it totally, and that's who moved my cheese, I think. It totally changed.
That's another good book.
Yeah, it totally changed. So a lot of people are like, yeah, I know how to do something great, but are you a great business owner? That's a totally different than having a great product, because a lot of great restaurants go out of business because they don't know the business part of it. They have a great product, but they don't know the business part of it. And some restaurant does really well. That's not all that great, but they understand the business, and that's totally different. So
Absolutely. Any other questions or comments before we close out?
And great presentation, Sarah.
Thank you.
Yes, thank you, Sarah. Thank you so much.
Well, I pray that I added some value today. We have something that I share often. It's called How Money Works. And it's a booklet that has a lot of basic information in it that's shareable. So Brother Ado, if you want me to send that out, definitely we'll send that to you. Also have a video on building your financial house. A lot of times, this is what I use with athletes. A lot of times we skip the foundational part and go straight to the fund, and then the house falls down when the income stops. So we always want to make sure we have some foundational information there. So if you'll just text your email address to 678-888-2094, I'll get that sent out to you. And then you also get a link to my calendar. So if you want to schedule a complimentary consultation to talk about things more in depth that's specific to you, would definitely consider me a resource. I appreciate the opportunity to share. I appreciate the opportunity to share this time and space with y'all. I hope that it was valuable, and I will hopefully see y'all soon.
Hey, one more question, Nakia.
Sure.
Hey, I know you work with high dollar clients, but is there a minimum investment that your baseline that you start working with? We want to make sure that we're using your time and it's valuable to you.
Absolutely. So I have agents that handle some of our clients that are on their way to $1 million. So, I mean, I have 18-year-olds that have Roth IRAs that are investing $25, $50 a month, right? That are working with some of our agents. I tend to work with people who have over 100,000 or more, just because they have access to other types of investments.
Okay.
But that's my specific sweet spot.
But you have a team, so thank you.
Yeah. Yeah. But my guys can handle all of it. But I have a person specifically who loves doing college funds. That's her thing. So yeah, so we can handle it. Thank you very much. I love that background. I had to get me a Zeta one.
I'll send you one. Raleigh gonna send you, because Raleigh is the king of technology. And so
Yeah, right.
Yes, send Sarah a couple of them, okay?
Send me one as well, please.
There you are. Raleigh got it. Hey, Raleigh, thanks again, man. You know, Raleigh and I, Raleigh is the chairman of the Better Business, and I'm his co-chair, but he does a great job. So kudos to you, man. And kudos to Sarah giving us our time and talents and sharing it with the frets. Raleigh is on you, baby.
I also heard this is her time. I told her she's got until noon. They said unless she was to kick off earlier, but yeah, it's all on her.
I can't talk that long, brother. This was a lot for me to talk. I'm like, I'd be like, okay, I'm tired of hearing myself talk. After about 45 minutes.
Hey, it was interesting though. It was interesting. It kept our interest. No, I didn't fall asleep.
Okay, everybody awake. Okay, good stuff.
You can never learn enough about finance, because I can tell you for me, and I can probably say for most African American, one is not taught in school. And most families never talked about it. It's almost was taboo to talk about your money. And it's sad because we should have known that a long time ago, but it's never too late to start today. Thank God for His grace and mercy.
Absolutely.
Hey, this is Eskridge. Before you take off, you got a couple of minutes. I'm driving, so I'll be brief. Do you focus on anything for organizations such as ours who are setting up scholarship funds that we might want to give scholarships from?
Oh, great question. Yes, I have quite a few nonprofits that we hold their funds for. So it's set up exactly the same as the trust accounts and things of that nature. So charitable giving is something that we're able to help with. Short answer, yes. Right. Thank you, brothers. I appreciate y'all.
All right, thanks, Sarah.
Getting on today. I know you want to hear about money early in the morning. This is a good thing.
Yes. Let me know when you have this edited and get that over to me. So, all right, I appreciate it. I'll see you guys soon.
All right,
Thank you.
All right, everybody. Have a great weekend.
All right, bye, guys.
All right.